give me about 5 minutes, and I'll explain what the Peltzman effect is supposed to be. Okay, so it's about the effect of regulation on people's behavior. And the general principle is that regulation often creates incentives for people to behave in ways that offset the intended effect of the regulation. The initial application was to safety regulation, okay, in particular to automobile safety regulation, which I addressed a long, long time ago before many of you were born. This is the regulation that required seat belts, safety glass, so you have an accident, you hit your head, and the glass goes that way instead of this way. All sorts of devices that were supposed to reduce the harm from auto accidents. They make us safe by protecting us. Okay, but the other side of this is that if there's less harm per accident, it increases the willingness to take risks. Okay, so you can think of it, I like to think of it as just simple economics. If you think about the overall price that you pay for an accident, it's gone down. You have an accident, you'll be less likely to be harmed at all, and if you're harmed, you'll have less harm. Okay, so we respond to any reduction in price by buying more. It's very simple economics, so we buy more accidents. So this has consequences. First consequence is for the basic question, does this kind of regulation improve safety? Well, all you can say is that the total harm is composed of the cost per accident, which really has gone down. I don't want any of you to run out there and not wear your seatbelt. If you get into an accident, it's very clear you'll have less harm if you wear a seatbelt. But your incentive to take risks has gone up, so the number of accidents will go up. And that's going to lead to more accidents. And you can't say from basic considerations what's going to happen to the total harm. Okay? In my original paper, the reason why it kind of I was the first one to address this very simple point as it applies to safety regulation. In that paper, that long old paper, there was a complete offset. I found that the first generation of these devices, in the context of U.S. behavior, led to no effect in terms of the total harm. Okay, it was complete. The reduced cost per accident was completely offset by an increase in the number of accidents. Now, I would never have an effect named after me if it stopped with that. There's a long literature in the area of auto safety in particular, safety regulation in general, that finds some offsetting behavior, often not complete offset the way I did, but it's commonplace in this literature to find some evidence of some offset, sometimes complete. It could be more than complete, so you can have cases where there's an increase in the total harm. Okay? Now, the other point I would like to make is that this effect is pervasive. It's not limited just to safety regulation. It occurs in a variety of contexts, and the general reason it occurs is that regulation can only affect directly a limited number of actions. In this case, the harm per accident. It can't control our behavior behind the wheel. So it's affecting a limited number of actions, and it's not changing the overall incentives that led people to have the kind of behavior they had before the regulation came along. So the things that it doesn't control will tend to change, and it'll tend to change in ways that offset the effect of the regulation. So let me give you a favorite example of mine, the example of the so-called Endangered Species Act, which is probably you have one in this country too. It's a law that tries to protect certain endangered wildlife by protecting their habitat. So effectively, this law says if your land or whatever, your property is a habitat for the endangered species, you can't develop it. So there's the famous case of the red woodpecker, which lives in forests in the United States, which are commercial. Okay, so if this woodpecker builds a nest in your tree, you can't cut it down. That's the law. It's designed to protect their habitat. The trouble is that these birds fly around. So you're driving through the forest one day, and you're a couple of miles from your property, and your friend says, "Hey, there's a red woodpecker up in the tree." What are you going to do? You're going to run, and you're going to say, "Oh my God, if that bird flies to my property, builds a nest, I'm done for, because the Endangered Species Act is basically going to take my property rights away." So you cut all your trees down. There's a more than complete offset. Something that could have been habitat for this endangered species is completely eliminated. And you know, I mention it because it's a case that's been studied the way economists like to study it, and it's very clear that the offset there is quite substantial. Okay, so now that's enough of a background. Again, if you have questions, please feel free to jump in. How does all of this apply to financial regulation, which is really the topic of my talk today? Well, financial regulation is safety regulation. You don't have to go beyond the initial application. Okay? It's supposed to protect the macroeconomy from the consequences of private risk-taking. That's really a regulation of risky behavior, just like automobile safety regulation. I want to try to convince you that the regulation has consistently led to offsetting behavior. In fact, it's created multiple offsets. The history is full of cases where you have a regulatory tightening to try to make things safer. There's an offsetting response to that, which creates another regulatory tightening, which leads to another offset. So you have multiple offsets. The question that I raised with regards to auto safety applies completely here. Has it, on balance, increased financial safety? Well, let's look at some history, and it's going to be U.S. history. So I have to excuse myself. You know, I don't know. I'm going to talk about Israel a little bit, but I know the U.S. history a lot better, believe me, than I know the Israeli history. And it's central. The U.S. history is central to the worldwide financial crisis. So I hope you'll pardon this emphasis on the U.S. And I'm going to start with this great defining moment in U.S. history, the Great Crash and the panic of the subsequent panic of 1933. You probably know some of this history because it's had worldwide consequences. We have a stock market crash. It creates losses for the banks. The losses lead to a deposit contraction. The depositors start fearing for the financial condition of the banks, and they start withdrawing deposits. This goes on for a few years, actually, on and off. It culminates with a massive run on the banks, an attempt by the depositors to get their deposits out. before banks fail, a bank holiday in March 1933 after Roosevelt takes office, and a lesson is drawn from this experience. That's to define financial regulation in the US and many other countries for the next several generations. The lesson was this contagious fear that starts in the stock market crash causes people to doubt the stability of the banking system. This contagious fear causes a systemic breakdown. And if the depositors were somehow insured against loss, there's going to be no fear, there's going to be no run on the banks, and there's going to be no systemic breakdown. That's the lesson that was drawn. Okay? You have to insure the depositors against loss, and all of these bad consequences will not follow. So we instituted in the US federal deposit insurance in 1933. There are consequences. First, for depositors, the bank runs ended. We went through a financial crisis, which, at least in the sense that these things occurred after the Great Crash, we haven't had a repeat. We had something similar to a repeat, but not exactly. The bank runs basically ended as a phenomenon of the type that we knew in the past. Depositors officially in the United States, it's if you have less than 250,000. Unofficially, even if you have more, you don't worry too much about being first in line. Many countries don't have official deposit insurance, but the belief, substantiated by experience, is don't worry if you're a depositor of a regulated financial institution. In the US, it's officially less than 250,000. You don't have to worry about this. There's no line, so you don't need to get in line. There are no lines. Okay? But, here's the but that leads to the application of the general principle that I started the talk with. The market discipline of risk has weakened. What do I mean? Well, go back to the situation before the creation of deposit insurance. Here we have two banks, just call Bank Aleph and Bank Bet if you want. Okay, so A over here is funded, they both have $100 in assets. It's funded by stockholders put up $20 and the depositors put up $80. And B has $90 of deposits and $10 that the stockholders put up. Okay? Before 1933, the depositor had to worry about how much money the stockholders put up, because the $20 or the $10 is the cushion that's protecting them against potential losses. Okay? If the value of those loans goes down, it's going to put the depositors at risk, and if you have the stockholders putting up $20, that's better than if they put up $10. So everything else being the same, the depositor likes Bank A. Okay? And you had a competitive system, basically, which provided a trade-off. A bank like A could offer a lower interest rate to attract deposits because it was safer. Okay? B has to offer the depositors a higher interest rate because there's only a $10 cushion. If the value of assets starts to go down, if it goes down below $90, the depositors are going to lose. That's the kind of eventuality that led to bank runs in the past, and everything else the same, you'd prefer A. So Bank B has to offset that with a higher interest rate. But the trade-off is that the stockholders have to tie up more of their money. So now let's get to the consequences for banks. You have deposit insurance. You don't need capital anymore to attract deposits. The incentive for the bank is to reduce its capital ratio to its legal minimum. If it's 10%, then that safe bank, A, with a 20% capital to asset ratio, wants to become like the less safe bank. Right? It's not going to be any better off by tying up $20 if the legal minimum is 10. So you get an increase in leverage. You also get increased portfolio risk. So let's go back to Bank B, the less safe bank. And all banks have an incentive now to become like that, but they also have an extra incentive, which is very important. So let's suppose that this less safe Bank B, its assets are invested in safe stuff, treasury bills or something like that, something which has an assured value. Well, then the bank will be worth more or less about $10, the value of the money that was put up. Suppose that, however, that it could go to a casino. I don't know if casinos are legal in this country. Let's say Las Vegas. It goes to Las Vegas, and it takes its $100, and it's going to play it at some machine which has a payoff of $200 if you can play either one of three colors, red, white, or black, and if you win, you get a payoff of $200. Now, from the social perspective, this is a terrible kind of bet. You have a 1/3 chance. Let's say you play white. You can come up red, black, or white. You have a 1/3 chance of gaining $100, turning the 100 into 200. And you have a 2/3 chance of losing the 100 that you played. This is a negative expected value bet. Right? Negative 33, you can figure it out very easily. 2/3 chance of losing 100 is greater than the 1/3 chance of winning the 100. But privately, it's a pretty good bet. What you have here basically is 1/3 chance of gaining 100 and a 2/3 chance of losing what? 10, privately, for the stockholders, the people who are making this decision. Okay, that's a positive expected value bet, as you can easily figure out. What are the consequences overall? Well, the deposit insurance stops the bank runs, but it creates what we've come to call moral hazard. That's the first Peltzman effect, if you want to call it that. Okay? A system designed to reduce the macro risk hands the banks an incentive to take greater risks. The government now has to substitute for market forces to reduce the incentives to, first of all, increase leverage, and secondly, to take greater risks with the assets. Okay? But this regulation doesn't change any of the underlying incentives. So you have to, whatever regulatory sitting down the government does on top of the banking system, you have to expect a response to that which offsets the regulatory tightening. That's the second Peltzman effect, if you would like. Again, a regulatory attempt to increase safety is going to create incentives to get around the regulation, and how? In ways which increase risk. Let me give you a brief history of how this has worked out, again, in American experience. The first response to deposit insurance in the banking system was a very fast leveraging up of the banking system. Capital ratios fell by half in a very short period of time. Ignore the box that has the letters FDI, CIA for a second, and just look at the period right after the institution of deposit insurance. Typical capital asset ratio was a little bit like that safe bank in my example, about in the upper teens, 16, somewhere between 14 and 18%. You can see right after deposit insurance is instituted, it falls by half. and pretty much it kind of fluctuates in ways that I will get into, but at a level well below where it was before. So there's an immediate response. You can just see it in this picture. There's good reasons why the capital asset ratio would otherwise have fallen also, but very clearly it happens very fast right after deposit insurance. So there's a plausible connection there. There's little effect of this for a long time. And then we begin experiencing, again, financial crises. The first one occurs in the 1980s. It has to do with, it starts in a part of the financial system which is specialized to the finance of real estate, this so-called savings and loan industry, which as a result of this crisis doesn't exist anymore as such. You don't have perhaps good analogies, good analogs to savings and loans in this country. You have some in many European countries. They're basically financing real estate, and they get into trouble in the wake of a lot of macroeconomic turmoil in the late 1970s and early 1980s, and also because they're not diversified. The turmoil has important negative effects on the real estate industry. They have, not only do they have all of their assets in real estate, they have them in real estate confined to local markets. So if you have the real estate industry getting into trouble and you're in an area of the country where the real estate industry is in particular trouble, you're dead in this. These banks begin to experience great losses, enough to wipe out their capital. And for a while, the regulators tried to ignore this. This is a very typical regulatory response, which we saw echoes of in the last financial crisis. Try to put off things. Eventually, we begin to have major bank failures. The most important historically is the seventh largest bank in the United States in the mid-1980s. One that was headquartered in the city of Chicago. It basically is failed. It's rescued by the government. This is historically important because the way it was rescued defines every subsequent extra-legal ad hoc step that the government took in similar situations. It also leads to a tougher regulatory response. The FDIC-IA Act of 1991 is designed to toughen regulation and to prevent such crises from happening again. There are higher minimum capital ratios. There's a so-called prompt corrective action. I don't want to get too much into the details. Basically, the prompt corrective action says if you start falling toward this higher minimum, you have to take action now, or we're going to shut you down before you lose all your capital. Yes, sure.
Yeah, you talked about the 1940s, about the ratio.
Yes, here's the picture, yeah.
But 40 years period is like a long time, so why you...
Yeah, why did it take 40 years? Well, that's a very good question. One of the first papers I ever wrote, actually, around 1970, I started my career in this area, and I wrote a paper on bank capital ratios, basically. And I discovered there was a direct connection between the deposit insurance and the capital ratios at the very micro level. And I said, it's very clear what they're doing. Right? I don't want to claim 1970 that I foresaw what was happening, but the incentives were very clear. They weren't playing themselves out. And it's a good question why it took more than 40 years before you see these symptoms. The best I can do for you, I don't know the answer. I was puzzled in 1970, except that I said, the banks are reacting to this, but they react sufficiently slowly so that you don't see anything happening in the short run. Coming out of the Depression, the banking industry was extremely conservative, as they are now. You should, all the talk is how do I manage risk? How do I avoid getting into trouble? The incentive was to take risk, but the reality of the situation was that you had people who had survived the Depression. They saw what happens if you take risk, and they were burned. The other thing is, the banking industry, as a result of World War II, is stuffed with government bonds, which are very safe assets. Their balance sheets actually weren't lending very much. It's related to two things. There's an economic boom in the 60s. 50s and 60s are an economic boom. They gradually lose the reluctance to lend money to real people. And then you have this industry which by law had to lend money on real estate. That's the one that gets into trouble first. All right? There's an interbank lending market. Continental Illinois wasn't a savings and loan. It was a big bank that invested in loans to savings and loan associations, loans on real estate projects that they went into in cooperation with savings and loan associations. So you have a spread of business opportunities that are inherently more risky. If you have a 10% capital ratio against government bonds and interest rates stay pretty much stable as they did up to the 70s and 80s, then you're okay. So that's the best I can do for you. It did take a while, but as we'll see, things they become much more frequent subsequent to that, and also, it's like Moses can't enter the promised land. You have to get all the people who were there at this traumatic time. They have to die off, and you get a new generation of people who don't remember the Depression. They're much more willing to take risks, and they have business opportunities present themselves. Well, to go back to the FDICIA Act, you can see there's a jump up about a percentage point, which is not trivial. I mean, it's going from 8 to 9. That's 12% very quickly. So there is a response. But it's not the end of the story. We have another crisis. This time it didn't take 30 years or 40 years. Within a decade, there's another crisis. Why? Again, none of this is intended to be a complete explanation of what is going on. This is a history of the regulatory aspect of it only. What's the regulatory aspect here? Well, the law focused on the capital asset ratio. It said you have to raise it. And you can't count certain things that were like funny money. You can't do that. You can't do funny things anymore. You have to really raise the capital ratio. But it didn't say anything, at least nothing new, about the riskiness of the assets. So the large banks react to the regulation by investing in riskier assets, in particular emerging market debt. Suddenly, they discover great profit opportunities in places like Mexico and Russia, Thailand. There's a devaluation of the Thai currency in the late 1990s. It creates massive losses on all emerging market debt. The banks get into trouble, particularly the very biggest banks now, not little savings and loan associations. And what's the response? More regulatory tightening. A lot of the blame for the financial crisis has been pinned on so-called deregulation. I'm not sure what they're talking about. This is a history of continual increased regulation. Now we're going to worry about the riskiness of assets. So you have, not only in the US, but worldwide, a move to attach weights to the assets. So if you invest in emerging market debt, you have to hold more capital per dollar of that asset than if you invested in treasury bills. That's the meaning of risk-weighting capital. What's the response to this? Well, there's an offsetting response here. The first thing that you want to do is to convince the regulator that your assets are safe. Right? Why? Because that's going to you want to avoid tying up capital if you can possibly do it legally. All right? Now you go to the regulator and you say, you know, if I invest in subprime mortgages, risky mortgages, that might be risky. But if I buy a pool of mortgages, a share of a pool which has 1,000 separate loans in it, that's not risky. So you begin to get a whole industry of what's called asset securitization, packaging mortgages, also slicing them into different sub-packages, and saying, you know, this is you know about insurance and diversification. Well, it applies here. You go to a rating agency and you pay them good money and you say that this is true. And then you go to the regulator and you persuade the regulator to accept the AAA rating in assessing the capital charge, which is now risk-weighted. So if you get a AAA rating, you have less capital to tie up than if you got a junk bond kind of rating. The other incentive is to move risky assets off the balance sheet. So we get the growth in the 2000s of what's come to be known as a shadow banking system. You find some unregulated entity, a hedge fund, an SIV, which means special investment vehicle, an investment bank, and you move the risky assets to that entity, but you whisper, you say, you know, this is actually AAA, it's very safe, but, you know, if something happens, we'll take it back. Shh. Right? The rest of the story is pretty much, I think, well known now. It turns out that this package of loans isn't any safer than any single loan if they all go bad at the same time, if the risk is highly correlated. And that's what happened with subprime mortgages when house prices declined ever so slightly beginning in the mid-2000s. It actually began before 2007. The whole system depended on house prices never falling. Suddenly, the AAA-rated paper lost most of its value very fast because everybody in the pool defaulted. The special investment vehicles, which were they were legal entities set up usually someplace like the Cayman Islands where they weren't taxed, and held a lot of this risky paper subject to these bank guarantees. They start to call on the bank guarantees. Suddenly the regulators see the liabilities that were hidden, and the special investment vehicles start to go back on the bank balance sheet. That starts happening in late 2007. And then other shadow banks become distressed. There's Bear Stearns, a middle-sized investment bank, full of this subprime paper. It is in distress in the spring of 2008, and then the rest of the investment banks in the fall of 2008 become financially distressed for similar reasons.